Good evening, ladies and gentlemen. Welcome to our weekly investor forum. I'm your host, Dan Theop, Senior Vice President of Investment Banking. We're happy to be back to bring you yet another investor update. And joining me today is none other than Justin Scott, Investment Banking Analyst. Welcome, Justin.
Greetings, everyone.
Today we'll be covering Scotiabank and Jamaica Boilers Group, and we're excited to share insights with you on these two great companies. If this is your first time here, then be sure to subscribe and hit the like bell to receive notifications. We upload content just like this every week. Also, if you want to embark on your very first investment journey, you should take that first step with Mayberry, of course. Follow us on social media to learn more about how you can get started today. Okay, up first, we'd like to present Scotiabank. Justin, what do you have for us?
Thanks, Dan. All right, so let's get right into it. So we'll be reviewing the Scotiabank results that came up most recently following the end of their first quarter at the end of January 2024. So if you take a look at your screen right now, you'll be seeing an increase in net interest income that's moved up 19% from $9.3 billion to $11.1 billion. We saw 102% in expected credit losses from $510 million to $1 billion. That really illustrates how aggressive they've been growing their loan portfolio recently. Net fee and insurance income that's gone down by 6%. Total operating income over the course of the period has moved up 5% from $13 billion to just $13.2 billion to $13.8 billion. Then we're getting down to profit before taxation, which has dropped 3%, but their net profit attributable to shareholders has fallen by 7% from $3.3 to $3.1 billion. So now this first quarter, as I'll illustrate a little bit further for you, has been a little bit choppy right now. There, as you know, Scotia's first quarter usually is. It's a bit seasonal, but they've been consistently growing right now. So they're more of a steady pace kind of bank. So if you take a look at their balance sheet, their total assets have increased by 11%, moving from $601 billion to $665 billion, up by $64 billion, of which $37 billion is just in cash. Their total liabilities are up 9% from $497 billion to $544 billion. And their total shareholders' equity is up 17%, despite their net profits being flat. So it's up from $104 billion to $121 billion. Dan can speak a little bit more to that. That's more likely an increase in their OCI rather than just the direct, net performance, net profit increases for the group. And moving into key statistics, we can get into it now. So right now, their share price is at 45.8, the PE of 8.3 times, just a bit below where the main market average PE is right now. So for people really looking into Scotia, the factors, the valuation is there that supports, if you're really looking to buy it. Book value per share is 39. It's moved up a bit from where book value is. So people were buying it just for, from exactly what the assets would be telling you. Then, I've actually commented on this a couple of times below where it was trading right at the book value per share. Now it's moved up a bit higher as people would have been taking an interest in Scotia. So trailing EPS is about $5.46. And trailing earnings is about $16.9 billion, which is really great, considering where Scotia was just like 2 years back prior, doing about like $13 to $14 billion. So it's really getting right back up to where they were pre-2019 region, right when they're at their peak. Share price has moved up. The 52-week high is 47.4, and the 52-week low being 30. So it's right around where their high is right now, but I do believe there's a bit more growth for Scotia coming up. So Scotia Group's quarterly profit movement, as I would have referenced a bit earlier, their first quarter is a little bit choppy, only doing about $3 billion this quarter compared to the previous ones before that all did over $4 billion. This is a bit seasonal, especially for a bank. It's a little bit off kilter, but I do believe as you can see, it's gradually growing as years go by. And that's as a result of Scotia's strategy now that's really benefits them in the sense of when we're having a bearish kind of market. So beforehand, and if I really want to comment on the difference between it and, say, its closest competitor, I would say NCB, which is much more aggressive and confident in their strategy with their, and that pays off for them in a bull market. Right now, we're in bearish territory where interest rates are high. It's a high interest rate regime, and it really benefits a company like Scotia that is very prudent in how they allocate their capital. They're very much risk averse. And things like this right now is really assisting to them. So high interest rates, they're really just, making money hand over fist on the repos. Their deposits have increased a lot because, granted, the benefit of a high interest rate doesn't exactly translate very well to us as consumers or just general people that are using the banks. a lot of people have been adding a lot more cash to the bank accounts. They've grown about 47.3 billion or 11.6% in core deposits. Naturally, as night follows day, Scotia would have increased their loan portfolio about $40.8 billion or 17.4%. And that's just gone mainly into things like mortgages, consumer loans, and things of that nature. And that's really been benefiting Scotia. So that's really where you're seeing the growth in their profit lines over the last couple of years. I expect that as long as we maintain this high interest rate regime, we'll be seeing a whole lot more of that. But how is this translated to their stock price movement? As I said before, it's been a consolidated range over the last 2 years with how Scotia's been performing. A little bit of peaks by about $30 to $47. So if you're able to get it like even below book value per share, which a lot of institutional investors like to go with that to that side of things, and then Scotia is there. But I do believe there's a lot more for Scotia to come, especially as we maintain this high interest rate environment. But once we cross over from there, I personally would like to go more towards a firm that's more aggressive in their output. As long as we're within the current standard that we're in right now, then Scotia seems to be doing really well right now. Dan, any thoughts on Scotia?
Yep, thanks for that. I think you're spot on. So I do want to make the point that Scotia is sort of the most conservative bank out there, and they're the ones you want when the waters get choppy. And then NCB is that aggressive bank out there that's got the shareholder who's demanding great returns. I don't
Right.
think Scotiabank Jamaica faces the same type of pressure for profitability. And so what does that mean to me when I'm sort of making my selection? I'm more of an aggressive investor myself. I'm looking to, double my money in 3 to 5 years. And so I lean more towards an NCB stock for that aspect of my portfolio. But when I'm thinking long-term pension funds, here's when I'm putting down for the next 10, 15, 20 years, I think Scotia. Interestingly, pretty much all of the bank stocks are down over the last 5, 6 years. I mean, I bought Scotia 6 years ago for $50. I bought NCB for $90. I bought Sagicor for $45, and I bought JMB for $38. They're pretty much all down except for, say, Sagicor, 45 to, say, 42
Right.
is down the least. NCB is down from 90 to, 65. Scotia down from 52 to 45. How do I feel about the future? I agree with you totally. Interest rates are going to start coming down in the next 3, 6, 9 months for sure. There's going to be a downward trend in interest rates starting in the next 2, 3 months, which will probably continue for 2 years. And that downward trending environment, all stock prices are going to rise, but I don't think all stocks are created equally. I think in an environment where Scotia has $300 billion of deposits, NCB has $500 billion of deposits, I think Scotia does well in this market where they can make 10% on government paper,
Right.
30-day government paper, 10% return. That's where the market is at today, and that's not sustainable. You can access a mortgage for 25 years at 8, 9%, but somebody can invest for 30 days and make 10%. Doesn't make sense. It is not sustainable. We're going to go back to a low interest rate environment, and the banks like NCB are going to shine, and the Sagicors who are working their money and not depending on government paper. Scotia, in their conservative approach to life, depends more on government paper. They're perhaps one of the largest investors in government paper. That's the Scotiabank model. But they will continue to do well. Spreads will be challenged, I think, as interest rates comes down. But there's no doubt that Scotia is rock solid and will continue to do well in the future, and is a good one to get in your portfolio when it's trading at an 8 times PE. But I think NCB is even better. So that's how I feel. I like them both. Good rock solid company, but I like the idea of having forgive my term, a master who's cracking the whip to say,
Yeah.
I need my returns because I care about the share price. It means something to me personally. Scotiabank Canada does not care about the stock price in Jamaica. It consolidates up into Scotia. The stock price is irrelevant. They consolidate the total assets. Speaking of total assets, great growth, 11% growth, Scotia, 17% growth in shareholders' equity. So it does mean that they're marking through OCI some fair value gains for bonds and stuff like that that don't come through the P&L, and that's why we see the shareholders' equity jumping. So I agree with you. Sorry to be long-winded, guys. So get yourself some Scotia, but get yourself some NSB as well, too. Okay, next up, Jamaica Broilers Group. Okay, it's no secret that this is one of my top 10 favorites, and it seems to be a favorite of Mayberry as well, too, because I note that MJE is a top 5 shareholder of Jamaica Broilers, so I do want to declare that. but it does not bias my analysis. Jamaica Broilers Group is simply a company that you must have in your stock portfolio if you are a serious investor in the Jamaica Stock Exchange and you're trying to grow your portfolio. Jamaica Broilers results for the 9 months ended January 2024. We see revenues growing by 3% to $70 billion, with 60% of those revenues coming from Jamaica, 40% coming from the US. You will all recall Haiti is no longer since October 2022. Gross profit growing by 5% to $17.3 billion. I observed that the gross profit margins in Jamaica are a healthy 13%, and the margins in the US a very healthy 10%. Distribution and administrative costs are up by 8 and 9% respectively, thus resulting in operating profit dropping marginally by 1% to $6.7 billion. We see finance costs increasing to $2 billion, and we take note that because of the expansion in North America in particular, that they're requiring additional working capital to fund that business, and so that's why we're seeing an increase in the finance costs. The result is the profit before tax falls 14% to $4.76 billion. What it's missing from here, there's a line item for the prior year, which included a $1 billion loss associated with discontinued operations of Haiti. And when you factor in that $1 billion loss last year they had a $3.5 billion profit attributable to shareholders compared to $3.8 billion this year. And so there's actually an 8% growth in profit attributable to shareholders and also an 8% growth in the total comprehensive income of $4.1 billion. Total assets up by 13% to $80 billion. So expect in 2 years' time for them to tip the $100 billion mark, which is quite notable. Total liabilities up by 17% to $70.5 billion. Again, they're taking on some additional working capital funding to ensure that they can continue to expand the business. Shareholders' equity up by an impressive 19%, or $5 billion to $29 billion. Congratulations, guys. So just one thing to note, we do see the 17% growth in total liabilities. I do take note of the fact that total debt is $38.5 billion vis-a-vis shareholders' equity of $29 billion. So running a little high on leverage, about 57% in terms of total debt to total cap. I'd like to see that down to 50%. So just a small adjustment. But this is a company that has been around for 65 years. And I promise you, with the likes of Christopher Levy and Ian Prasad at the helm, Robert Levy, who is, sort of passing on the baton to Chris. This is a great family-run business. They know how to raise financing and how to run the business. $38.5 billion worth of debt. It's a debt to EBITDA of 3.5 times, so not too bad. Fairly reasonable, 3.5 times debt to EBITDA. Interest cover of 4 times, so very conservative from an interest cover perspective. So all in all, I think they're doing a reasonably good job of managing the debt. Although I would like to see them work that down a little bit over time. But what do I mean by saying these guys know how to raise financing? In their previous financial year ended April 2023, they raised $27 billion of new debt and repaid $16 billion. I would love, Ian, to see in your audited financial statements a little bit more about the debt. I can't tell who the institutions are exactly. I can garner what the interest rates are. Your average interest rate's about 6.9%, which is reasonable. And I can tell that a third of your debt is Jamaican and 2/3 of your debt is in US and US dollars. So you're running a fair amount of US dollar borrowing. Presumably you can reprice your chicken to cover that, but your revenues only have 60% revenues in Jamaican and 40% in US. So there's a tad bit of a mismatch there. But again, I think these guys are more than capable of managing the debt. And with interest cover of 4 times, I think they're doing a pretty good job. But I would like to see the debt managed down over the next 3, 4, 5 years. But this is a business that is poised for growth. They're a market leader in Jamaica. And as the hotel sector continues to expand, we're going to see a lot more consumption. So don't think to yourself, they're tapped out with the growth in Jamaica, which makes up 60% of the revenues. I still think they have good opportunity to grow in Jamaica. But in the North American market, which now makes up 40% of their revenues. They have demonstrated that they are capable of growing, and there's huge potential there. And the margins at 10%, segment profit at 10% is pretty healthy, 9.7%. So definitely a company that I like. They're extremely well positioned in Jamaica, and they're poised for growth in North America. And they really do a good job of managing this business. Next slide shows the quarterly profits, and we can see $1.3 billion in the last quarter. They are consecutively breaking the $1 billion mark. And I had Christopher Levy here a year ago, and I said, Chris, we need to see you guys consistently doing better than $1 billion. And he's responded, folks. In the last 4 quarters, only 1 quarter did we see the profit below $1 billion. So that makes me very hopeful that in the next quarter to come, we'll once again see them doing better than $1 billion, which means the profitability of the business on a trailing basis will continue to improve. Going back to the key statistics on the first page, current stock price at $33, trailing earnings of $4.7 billion gives you the price earnings ratio of 8.44 times. So the stock is trading relatively cheap in a market where the average main market index PE is 10 times. So this is down by 15% relative to that. And then this is a growth stock. And so I really think it ought to be trading at closer to 10 to 12 times. Plus, as we keep saying here on the program, as interest rates trend down over the next 3, 6, 9 months, I think we're going to see the main market average move to 12 times on average. So 2 reasons why I think this stock price is undervalued by anywhere from 20 to 40%, and why you should go and get yourself some JBG at $33. Next slide shows the actual stock trading performance. And you can see that it's been trading relatively flat for the last 6 months, going up and down a little bit. But in general, it's a great stock that you'd want to get in your portfolio. In the last 52 weeks, we've had a high of $38 and a low at 30. So it's sort of right there in the middle. But again, at 8 times PE, this is relatively cheap, and you ought to get yourself some JBG. Justin, what are your thoughts?
JBG seems to bring a whole lot of things right now. They're really growing their business. I noticed that there's a lot of activity now in the U.S. markets, especially because they've narrowed their focus a bit more. So now they don't have to worry about Haiti since abandoning the operation over there. So now it's split between Jamaica, which is their crown jewel, and their operations over in the U.S. Especially referencing their sale of the hatchery that's happened pretty recently, that they bought in 2016 for around like $8 million US, and they've sold this now for $23 million US. So this happened pretty recently. The way they phrased it in the excerpt that I read from the Gleaner was that the opportunity to sell just came up. So I don't know if, and as I said, they bought it for 8, they sold it for 23, then, it's a no-brainer right there. So I don't know if they have the plans right now for a brand new operation that will go pretty quickly. But I know they're flush with cash, even though they've reduced some of the operations, reducing some of the assets. They're pretty flush with cash. Some of them probably went down towards paying off some of the debts earlier. As it said, about 2/3 of the debts seems to be that it's over in US dollars. So that's pretty good. Maybe they have their eyes on something set closer to where their other operations with the chicken processing plants over on the East Coast. So, we might be seeing some pretty good stuff out of them pretty soon. I don't know if they have, as I said, I don't know if they have anything outlined immediately. So maybe some of the cash will just sit in now and to go towards closer investments, repositioning, upgrading, and refurbishing some of the plants that we have either here or overseas. Maybe they might pay out a dividend, who knows? So we can only wait and see a bit further for what the direct plans are for Jamaica broilers, but they're in great positions, great directions, with grain prices coming down a bit more to offset the prices of inflation and the rest of their input operations, then, expecting good things from Jamaica broilers.
Good. I couldn't agree more. And we'll definitely get Chris back on the program in the next 3 months. So I think from Justin and I's perspective, these are both good buys for slightly different reasons. But in general, we're excited about the market, the prospects, what's to come, especially as we go from this bearish market, I think, to we're going to see a bullish market. I'm going to bet my bottom dollar in the next 3 to 6 months, with close to $200 billion of cash sitting on repos, earning 10%, folks are getting a little bit fat and lazy.
Yeah.
And I think when you see those interest rates coming down by 200, 300 basis points, you can no longer sit and earn 10% and cover inflation of 6 or 7%, then folks are going to be tempted to go back more into real estate or more into equities. I think real estate is challenging. Equities are just a lot easier to go. And then folks naturally will turn to the blue chips that are trading cheap, and JBG and Scotia are definitely blue chips that are trading cheap. Well, folks, that's it for our discussions today. I'd like to thank our viewers, as usual, for tuning in. Your support is always appreciated. And I'd like to thank my co-host, Justin, for his great support. Thanks, Justin. Appreciate it. If you're curious about updates on our virtual investor forum, then find us on social media. We share our live stream updates and our upcoming guests on our social media pages. Give us a follow and stay on top of all things forum related. Also, don't forget to subscribe to our YouTube channel, Mayberry Investments Limited, and click the bell to receive all our notifications. Keep safe, folks, and remember, wise investors, slow and steady wins the race. Goodbye.